Hello, everyone. Happy Monday. Welcome to this webinar. Really happy to have you all here. As a reminder, it is being recorded. We hope that you all had wonderful Thanksgivings and holiday time. And we're going to dive into some tax advantage giving with our guest, Bill. But before we get into that, I want to do some quick introductions. My name is Josh Roth. I am the Director of Planned Giving here at Compassion and Choices, and happy to be working on all of this with you. I'd like to pass it over to Andrea Brannon, our Chief Philanthropy Officer.
Hi, everybody. My name is Andrea. I'm the Chief Development Philanthropy Officer here at Compassion and Choices, and we are so excited to have you all with us today. And with that, Bill, your turn.
Hello, and thank you for being with us today. My name is Bill Albrecht. I am a consultant in the major and planned gift space. I've been involved in the nonprofit community for 34 years now, and I've got a little bit of background in the tax strategies, and so I'm very much looking forward to sharing some of these ideas and information with you guys today.
Thank you, Bill. One more introduction. Miladies at the bottom of the screen. If you all ever reach out about anything planned giving, you will either hear from me or Miladies. Miladies, if you want to say hi real quick.
Hello, everyone. It's a pleasure to be here. As Josh said, you might hear from me now and then. And I am just so grateful to be part of this wonderful PG team. Thank you.
Thanks, Miladies. All right. So as a reminder, we do have a Q&A box at the bottom. You'll see it at your toolbar. If you have any questions during the presentation, please throw your questions in there and we will get to them through the presentation. Andrea will be running that for us and letting us know as things pop up. So with that, Bill, you ready for me to throw some questions at you?
Yeah, let's get started.
All right. So to kick things off with an easy one, it is the end of the year. So of course, Compassion and Choices is in our end of year campaign. So can you talk a little bit about the easiest way and the best way for people to make a cash donation to Compassion and Choices?
Yeah. So if we're thinking about cash gifts, really the easiest options are going to be to go online with your credit card to the website and make a gift that way. They're received in a very secure fashion that way, and it just gets posted to your credit card. Another option is to write a check and use the business reply envelope that goes out with like direct mail pieces. And so that's another option that's available. And then for some people, a donor advised fund may have some balance in it. And that can be another way is to direct the custodian of your donor advised fund to make a distribution to Compassionate Choices.
Awesome. Thanks. And a little side note to that, as you all know, tomorrow is Giving Tuesday. Compassionate Choices is offering a 100% match on all gifts made tomorrow. So if you're waiting on giving a gift, a cash gift to Compassionate Choices, consider doing it tomorrow and it will be matched 100%.
That's pretty
With
cool. I
that,
didn't know that. That's pretty cool.
surprise.
Yeah.
So let's dive into some heavier content. So can you talk a little bit tax-wise about how the standard deduction impacts the tax benefit that people might receive from giving to Compassionate Choices or other charities of their choice?
So when people do their taxes, there's two ways to claim deductions. You can either itemize your deductions or you can claim the standard deduction. And when people are figuring this out, or your tax professionals figuring this out, they're going to take whichever one is better for you. With the standard deduction, it's just an amount that is available that reduces your taxable income. And so if you're using the standard deduction and you're also making charitable donations, you may not get a special tax write-off for the charitable donation like you would if you itemized, but the value is kind of already built into that number that you get to use for the standard deduction. And so that concept of itemizing versus standard is something we'll touch upon in a couple different ways today. But that's maybe a good way to kind of frame it at the beginning.
Awesome. Yes, Andrea.
Sorry. Somebody
Please.
asked what the standard deduction is for this year. So I just wanted to pop that in since we were right on top.
That's a great question. Let me give the exact amounts for that. Um, One second. So for a person who is single and filing as a single filer, for 2025, it's $15,750. And for a married couple filing jointly, it's double that or 31,500.
Awesome. So
And
then,
so just to kind of like build on the last comment, if your itemized deductions are above those numbers, given your filing status, it's going to make more sense to itemize. And if they're not, then you claim the standard because that's going to give you the most reduction to get down to your taxable income.
so talking at a philanthropy level, basically you would like to be giving over $30,000 if you're a married couple to itemize.
Right. And all of it to compassionate choices.
Of course. Absolutely. Okay. Um, awesome. So another question I've got for you. So going as far as like more tax efficiency. So instead of just donating $30,000 in cash, might there be benefits for donating stock or mutual fund shares or anything like that? And can you talk a little bit about those benefits versus just donating cash?
Yeah, now we're starting to get into some more strategic ways of giving. Um, with an appreciated asset that you own, typically what occurs in this dynamic is somebody purchases something and they have their purchase price. And then if it appreciates in value, it grows in value. There is something called capital gain that then occurs. And that capital gain does not really apply. The tax on that gain does not really apply until the asset itself is sold. And so for some people, it can be advantageous to take a look at their investment portfolios. It can be individual stocks, it can be ETFs, it can be mutual fund shares, although there's a little extra wrinkle with the mutual fund shares. But any type of asset like that, a financial asset like that, where there is this gain, if you donate the asset rather than hanging on to it and then selling it, you're going to typically, if you itemize, you're typically going to get a charitable deduction for the full value of your gift at the time it's made. And then when Compassionate Choices receives that asset, being a nonprofit organization, being a tax-free entity, it can sell the asset without any capital gains tax being taken out. And so, from a tax efficiency standpoint, there is the benefit, obviously, of making a donation, cash gift, standard, whatever. You're helping the organization. There's the benefit to itemizing if your total itemized deductions go above the standard deduction level. And then there's this other little benefit around appreciated assets where capital gains tax that might otherwise be in your portfolio and waiting to be taxed whenever you sell that asset um, can be given away. And then CNC can receive the asset, sell the stock, let's say in this example, and no capital gains is taken out, and you still get the full fair market value deduction for your taxes.
Amazing. So, sorry, excuse me. So if someone wanted to donate appreciated shares to Compassionate Choices, what's that process look like? How does that work?
Well, it's pretty straightforward. They would simply need to get your brokerage information, which probably is available on the website. I'm not 100% certain, but certainly they could reach out to anybody there and get that information. I see you guys nodding, which is great. There's the account number, there's the name of the brokerage, obviously, there's the account number, and there is also a DTC number that's involved to make sure that like it gets routed correctly. But what's really key in this process is that you're actually transferring the shares, whether it's the ETF shares, whether it's the mutual fund shares, whether it's the individual stocks, because that's what enables that capital gain to be captured at this level. And then in turn, when it's sold by Compassionate Choices, there's no capital gains tax that's being taken out at all. So.
Awesome. I do see that we have some DAF questions in the chat. We'll get to that in a second. But one quick follow-up. Talking about gifts of appreciated stock, can we talk about some additional planning opportunities or other cool, unique ways
Yeah.
to donate stock and how that can help you tax-wise?
Yeah. And then remind me to come back also to one other dimension on itemized deductions versus the standard deduction, because there's a little strategic piece I want to make sure we don't
Yeah.
lose there. Um, so a lot of times when somebody is looking at their investment portfolio, let's say, they might be looking at a company that they really still believe in. And the tech stocks, for anybody who's involved in the markets, the tech stocks have been the ones that have really ripped it ahead in terms of value. And for people who were fortunate enough to get some shares, at an earlier stage, they probably do have some capital gain and potentially quite a bit of capital gain involved. And at the same time, they might be looking at that company and thinking, I still believe in this company. I still think there's more to grow in the value of the share. So I'm not really sure I want to give it away. And I'll pick a name that everybody knows, NVIDIA. Let's say somebody bought NVIDIA back in 2020. There's quite a bit of gain that's occurred, but there's a lot of belief. I mean, I know it's the valuation's way up there and everything, but there's still a body of thought that suggests that NVIDIA is going to stay strong for a while. As a strategy, as a potential strategy, a person could go ahead and give the NVIDIA shares that they were otherwise looking at with maybe a little bit of hesitancy, and do that as an alternative to making a cash donation. So they keep the cash, they donate the stock. Everything that we've talked about so far with giving away the capital gain applies. Compassion and Choices can sell those shares, no capital gain. They get the full value of your gift. You get the full value of the write-off when you itemize your deductions. And you're sitting with this cash that you didn't donate. You can actually take that cash and repurchase the same value in NVIDIA shares and replace those shares in your portfolio. But here's the benefit. Here's the secret sauce to it. When you do that, you're establishing a brand new cost basis for the same shares. So instead of that 2020 cost basis that you had way back when you first bought those shares that you've been kind of carrying, you're now establishing a brand new 2025 cost basis, and you're resetting the capital gains tax going forward. And it's a super strategic way for people to donate when they have investment portfolios, and when we're in a period of time like we are right now, where share values by and large have increased in recent years. Um, and there's one little twist and one little caveat that sometimes comes up, and I'm just going to mention it so that I can mention that it does not apply. But when we do tax loss selling in our investment portfolios, there's something called the 30-day wash sale rule that kind of prohibits the benefit of a tax loss sale on 30 days either side of the transaction. So there's this kind of waiting period. But that, if you've heard of this, it does not apply to charitable gifts. It only applies to tax loss sales. So literally, you can do this on the same day. You can initiate the transfer of NVIDIA shares to CNC on a Thursday. On that Thursday, you can use the cash that you otherwise would have donated to buy the same number of NVIDIA shares, and you're gonna get this reset of your cost basis. And so there are people who will kind of on an ongoing basis, when they're thinking about their philanthropy, look at their investment portfolios for these appreciated shares, and then over a continual way, they're kind of improving the tax dynamics of their investment portfolio. And it does apply to, again, gifts of stock, gifts of mutual fund shares with an asterisk. Let me leave mutual fund shares to the side for this comment, but it applies to stock and it applies to ETFs, exchange traded funds that you may have purchased. So it's just one strategic way to think about philanthropy.
Yeah, it's a great way, especially if, excuse me, if someone is already planning on donating a certain amount to an organization to just still make that donation, but then make their tax burden so much less going forward.
Totally. And you're still getting the write-off, whether you do the cash or the stock. So why not get the added part of this capital gains
Absolutely.
forgiveness? So
Thinking
yeah,
future planning.
yeah.
Um,
And then circling back on the one comment I wanted to make before we lost it about itemizing versus the standard deduction. Um, We talked about how in a given year, you're going to take a look at kind of what your itemized deductions might be and then see what that number is. And then you're going to take a look at what the standard deduction level is and see what that number is. And you're going to pick the bigger of the two because that number that you pick is subtracted from your adjusted gross income to arrive at your taxable level of income, roughly, primarily speaking. So one strategy that people will use is something called bunching their deductions, where they might attempt to make a couple years worth of charitable donations in a single year, especially if they're kind of really close, but maybe just a little bit below the standard. And then by bunching the deductions in the first year, you get your itemized level up. So it's a bigger reduction from taxable income. And then in your off year, when you're below, you're claiming the standard deduction in that year. And so then rather than kind of being at this even standard deduction level the whole time, by doubling up every other year, you can be at this level, up year, be at this level, up year, and always get that incremental benefit of those up years along the way. So I just wanted to make sure I didn't forget to mention that. So.
I love that. That's such a cool, different way to think about philanthropy. I mean, obviously, we will be fundraising every year after year after year, but for people who choose to
Yeah.
give on every other year,
Well,
love
that's a
that.
great point. I mean, that's a great point too, because it's communication. You might make a special gift, in the odd year, but you're communicating with Compassion Choices. Hey, this is a 2-year commitment that I'm making with a single gift, and then as long as the communication's there and it's understood, it's just good donor relationships at that point. So,
Yeah.
yeah.
Awesome. So, switching topics, let's go away from stocks for a second. There's a lot of talks about IRAs and qualified charitable distributions. Can you, at a base level, talk about what a qualified charitable distribution is?
Yes. So in our traditional tax deferred retirement accounts, we have this opportunity to have all this money go in tax free, grow over time, tax deferred. And only when we pull it out do we actually pay income tax on it. It's built into the tax code. It's entirely designed to help people prepare for retirement through saving and not just, relying on Social Security or something like that. So it's a great tax strategy. Hopefully, people have participated broadly in putting this money away. With our IRA, there is also an opportunity to make a direct transfer of funds to charity. Now, it's just the IRA, it's not the 401k, not the 403b, just the IRA. And that direct transfer is called a qualified charitable distribution or a QCD for short, just the initials. Um, and when you do that, it's a direct transfer. You're just calling your IRA custodian, Fidelity, Schwab, whomever, and saying, I would like to do a qualified charitable distribution to support Compassion and Choices. There's a form available online. The person that you talk to on the phone can, if you've never done one before, they're super easy. But if you've never done one before, the person, a representative at the company can direct you to the form. There's just a little bit of information about Compassion and Choices, the legal name, tax identification number, that's that type of thing. And then that distribution will be made. And it's another way to make a gift. So at a simple level, that's what it is.
Okay, thank you. So, can you talk a little bit about the difference between making a QCD versus just I'm going to take money out of my IRA and donate it that way? What's the difference?
Yeah.
What's the benefit?
Um, in probably 99.9% of the circumstances out there, it would make more sense for a donor to make the direct transfer from the IRA. Because a distribution that you take out from the IRA and put in your checking account first, before maybe even writing an identical check, it goes through the tax window. And by going through the tax window, it increases your adjustable gross income. And there can be some dominoes that tip. They're kind of situation specific, but there can be some dominoes that tip when you do it that way. And you've boosted the adjusted gross income by a certain level that don't tip if you're not bringing your your AGI up if instead you're using this to make this direct transfer over to compassion choices. And those dominoes, when they tip, if they tip, they're not advantageous, they're disadvantageous. So you avoid that potential outcome, even though you might be writing a check for the same amount, and even though you might be getting a charitable deduction that you're itemizing in that amount, you still don't want that front end tipping of those disadvantageous dominoes. So
Gotcha. And I think that could also come into play depending on what the 2026 brackets look like, which I think we now finally know and we'll
yeah,
discuss a little bit
yeah.
later.
But even before we look into 2026, um, that for somebody who's 70 and a half and older, and this again is the age, that's the minimum age threshold that you need to arrive at before you can actually do one of these. And it is just the IRA that you can do it through. If this is an option that's available for you, the best possible thing to do again for like almost everybody is to use the IRA and use the QCD, make the direct transfer. You're not going to get an additional deduction for it because again, it's not going through the tax window, but it's also not going through the tax window, so it's not creating these potentially, adverse outcomes. And the worst scenario is where a person takes a taxable distribution, puts it in their checkbook, and then in turn writes a check to Compassion and Choices. And then they claim the standard deduction. And so if you're claiming the standard deduction already, if you're not itemizing, putting it in your checkbook first, you're not going to get the write-off. It's built into the standard deduction, but there's no additional benefit. So just claim the standard deduction, do the direct transfer, and then that cash that's sitting around or whatever, save that for other life purposes, not your charitable giving. Save it for other life purposes. And then think about your charitable giving coming from the IRA, and you're just kind of like maximizing the tax efficiency of the option. So.
Awesome. Got a couple questions.
Sure.
Jane, I think yours was just answered about can a QCD be used for an RMD? Yes, absolutely.
Yeah, let's talk about that. Let's talk
Yeah.
about that. Um, so at the beginning of this topic, we talked about how we have this opportunity during our careers, obviously the decades that we're preparing for retirement, to tuck money away on a tax-free basis, have it grow tax deferred, and only when we pull out money do we pay income tax on it. Um, Built into the code, the whole approach is to encourage Americans to save and prepare for retirement. When we turn 73, um, there's a switch that flips, and that switch is a required minimum distribution, an RMD, a minimum amount that we are now required to take out by law. And there's penalty and some other stuff if we fail to do so. And effectively, the IRS, the government is saying, hey, we've given you this break. Hopefully, you've enjoyed it for decades, but we want a little something now. It's there for retirement. You got to start using it. One of the nice features of a qualified charitable distribution is if you do that and you make gifts to charity using these QCDs, it counts dollar for dollar toward the requirement. So literally at age 72, somebody's sitting there, no requirement. I'm going to make up some numbers, but they're going to be really solid ballpark numbers. Let's just say I've got $1 million in my IRA. I'm 72, no requirement to pull anything out. I've got other assets that I'm using, other income sources or whatever. I'm living fine. I turn 73 and I suddenly have this requirement. It's going to be in the ballpark of around 4%. There's a table, there's an IRS calculation that determines the exact amount. Our IRA custodians and retirement plan custodians are really good about staying honest and letting us know what we have to do here to make sure we don't get a penalty. But with the IRA, we can make this QCD, this transfer to charity, and have it count dollar for dollar against the required amount. So age 72, no requirement. Age 73 with $1 million IRA, it might be $40,000. we can decide how much, all of it, none of it, some of it for charity, whatever we want to do, but that requirement kicks in at 73. But if we're philanthropic, the QCD itself starts at 70 and a half. The requirement to pull money out, like the knife in the back saying, hey, we got to do something here, kicks in at 73. That can be another important incentive for looking at the QCD as your option for philanthropy. So.
Awesome. Got a couple other questions. Do you know, is there an administrative cost to process a QCD?
No.
Amazing.
Nope.
And the
It's
other
just as
question,
far as the IRS, or excuse me, as far as the IRA custodian, the Fidelity, the Schwab, et cetera, it's just built into their fee structure. So there should be no additional cost. I guess I can't speak for every potential IRA custodian that exists out in the universe, but not with the Fidelities or to my knowledge, not with the Fidelities or Schwabs or any of the majors. So.
gotcha. And then is there, so required minimum distribution directly from the investment fund? That's all totally fine. Um, Sorry, catching up on some
From
questions.
from our yeah, from all of our retirement, we could still have this from our 401k, still have this from our 403b. It's worth noting that the charitable option, the QCD, is only available from the IRA. And it's also worth noting that the deadline for QCDs is December 31st. Now, some of us might be familiar with the April 15th deadline where we can still contribute to an IRA. That's still intact. But the deadline for the QCD is the 31st, and the funds have to be received by Compassion and Choices in their account by December 31st. So it's not even like the postmark date. And so if anybody's thinking about the strategy, quite honestly, do it in the next couple of weeks. Do not let the holiday press of everything. I would probably think, I mean, we're already at December 1st. I'd probably think, no later than the 10th or 12th, to be safe. So.
Gotcha. And there's no minimum requirement, no minimum amount. It can be any amount for a
I've
QCD.
seen $100 QCDs.
Awesome.
Yeah, there is a max,
Oh,
and for anybody contemplating the maximum amount, in 2025, that max is $108,000, and that number is indexed for inflation. So in 2026, I don't know off the top of my head exactly what that number will be for 2026, that tax year, but it's 108,000 for 2025. And those, I mean, honestly, those are the gifts that you more commonly see at that level in campaign environments. Somebody's doing a big major campaign, there's a big, huge fundraising goal, and donors might want to step up with a leadership gift or some, very special show of support for what's going on. And, QCDs can be a terrific way to do it, maybe over a multi-year period even, but that's where you tend to see people hitting that maximum amount.
awesome. I think looking at our other questions, um, I want to jump over to donor advised funds, and then we'll come back to some other QCD RMD questions if we have them at the end. But a lot of people and a lot of donors to Compassion and Choices have donor advised funds. Can you speak a little brief? Can you speak about them and how they work?
Yeah. So donor advised funds provide some important flexibility to donors. And the way that they work is you establish them maybe at a community foundation, maybe again with like a Fidelity or a Schwab, and they become the custodian for the donor advised fund. When you transfer funds into a DAF, there's often minimums. They might, vary from one organization to the next. But when you transfer your funds into the DAF, that is when you're making your charitable gift. That's your taxable, tax deductible gift, excuse me. And then at any point after that, you get to decide, which organizations you'd like to make a distribution to, how much, when, all of that. And so there's some nice planning flexibility for people who maybe aren't 100% sure of all of the charities that they might want to support, but they do want to get a certain amount in for the year. Maybe it's some tax planning, that's taking place. And so you can get it into the DAF before year end, and then over the course of time, make distributions. And it just provides really important flexibility. There's no additional tax benefit when you make the distribution to the charity. Again, it's up on the front end, which is the timing piece that creates the strategy. There's no additional benefit to the tax benefit when you make the distribution to the charity, but it gives you the flexibility. And this is a good topic, honestly, because we talked about that bunching strategy and maybe making 2 years of giving, to the organization at one time and then having communication and having it all be kind of understood. That's all fine for sure. But you could also look at your DAF as a way of making 2 years worth of charitable contributions. And then you can decide to then distribute to the charities more evenly over that period of time. And then that even flow of revenue and giving flows through the charity, which helps with, planning and all that. And then the donor in this scenario is getting the standard deduction in 1 year and the bunching deductions in 1 year, and then the standard and the bunching. And so that can be another way to kind of connect this back to some overall tax planning. So.
Gotcha. So we actually have a little bit of a scenario in the questions. If you have a second. So it says married couple with an adjusted gross income of $150,000. Is there a difference between putting $30,000 in a DAF versus putting $50,000 in a DAF in 2025?
The answer is yes. I'm gonna leave behind any relationships like tax advice or anything like that, like specific to a scenario. But the answer in general is yes, because the primary sources of itemized deductions are property taxes, state and local taxes, property taxes, and any state and local stuff, um, mortgage interest, and charitable deductions. So those are the three primary categories. There's other ways that like medical expenses could kind of get into the calculation as well if somebody has a really significant amount of medical expenses in a given year. But these are the three main ones. So when you're looking at whether it's better to itemize or whether it's better to take the standard deduction, those are going to be the three categories to think about. So if somebody's state and local income tax plus mortgage interest, any remaining mortgage interest, plus philanthropy is going to get them over that 31.5 for 2025, or could. That would be a scenario to consider, maybe doing 50, like the question raised, and then you get it into the DAF, you get the write-off this year, and then you can think about timing for your distributions, to support compassionate choices, and potentially any other organizations that you might want to make. And I will make note also that gifts of appreciated stock and assets like stock ETFs, those are okay for your DAFs. So you can lock in the capital gains side of this with your giving as well. QCDs are not available for DAFs. They only work for the direct transfer to compassionate choices. So I want to just make that distinction as we're talking about DAFs. So.
Gotcha. So follow-up question. So is there a minimum age to establish a DAF?
No.
Perfect. And then you said that you can't have a QCD go from an IRA into a DAF. It's a lot of letters. But
Correct.
but can you fund a DAF with anything from a 401k at all, or does it have to be taken out of the 401k and then separate into the DAF?
Got to go through the tax window first. So our tax deferred retirement accounts are not good for DAFs. Our investment portfolios are terrific for DAFs. Yeah.
Awesome. Okay.
And just a quick parenthetic comment from Tangent Land. We've been talking about appreciated assets in the realm of like financial assets, capital gains on the stock that we bought years ago, and how it builds over time, and then if we sell it, we pay capital gains tax. This capital gains tax also applies to real estate. potentially investment real estate. And so there can be less common scenarios where a donor might want to consider a gift of real estate to an organization because of some capital gains, because of some other planning goals. Um, there are things like charitable trusts that we're not going to get into today that can work really well for gifts of real estate. But I just want to make mention that there's these other types of asset categories and other types of planning opportunities that exist in addition to what we're talking to today. But that capital gains dynamic still holds. So I just wanted, that's my tangent. So.
Happy to hear it. One question going back to RMDs just a little bit, and this is from one of the attendees. The 108,000 max that you were talking about, that's a total of like throughout the year, or is that a single gift total?
Total cumulative for all of the qualified charitable distributions that you might make in a given 2025 cycle, whether it's one or a 10.
Awesome.
It's just
Great.
the maximum dollar value that you're allowed to transfer via a QCD.
Cool. All right. One more little category before we get into some of the changes coming in 2026. At Compassion Choices, we've got quite a few people who engage in charitable gift annuities with us. And I would imagine that there are some people on this call that don't understand what those are, how they work. So can you kind of break that down?
Yeah, it's another option that's available with giving, where instead of making just an outright gift to the organization and saying, "Here's my gift, please continue to do good work," I can instead, with a charitable gift annuity, say, "Here is my gift, but I also would like to retain an annuity payment that Compassion and Choices would make back to me over the life of the annuity." And typically that's going to be the life of the donor who's making the gift. And so this option appeals to people that maybe want to make a bigger gift, but just kind of like the idea of having a little bit of cash flow coming back in return. And as Josh mentioned, there's quite a few people who like this idea. It's not for everybody, but some people, they really just appreciate the idea. Um, Gift annuities they have a little bit of regulatory context associated with them, but I know that Compassion and Choices has already dotted all the I's and crossed all the T's, and that regulatory context is state by state. But we know from this that Compassion and Choices is set up in all 50 states, so it doesn't matter where you live. This could be an option. They typically start to kick in when somebody's getting into their 60s. The rates just are not very attractive for younger donors. And I'm not recalling, but Compassion and Choices may actually have an age minimum that you have to reach before they'll look at a gift annuity. But this is just another opportunity. There is no barrier to cash to do a charitable gift annuity. There's no barrier to appreciated financial assets to doing a charitable gift annuity. There are more complex scenarios that would not really apply for year end if somebody wanted to contemplate real estate for a gift annuity. And there's a very special rule that allows a one-time transfer from an IRA to using the QCD to create a charitable gift annuity. It's got a cap. I think it's 53,000. It's either 53 or 55,000 in 2025. It's a one-time in a person's lifetime under the current rules option. And in that case, there's a little bit of like tax. There's some tax characteristics about how the annuity payment that's received back by the donor is taxed. And in the normal scenario, part of it's going to be taxable, part of it's going to be a tax-free return of your original gift that you've made. On this side with the QCD option, it's 100% all taxable. Again, because the QCD has never gone through the income tax window, so 100% of the annuity payments taxable. So there's a little bit there.
Awesome. And are there any other tax dynamics for a charitable gift annuity that people should keep an eye out for?
For gift annuities alone, I'm trying to think. I think it would just be situation specific, you know. Like if the donor and the person receiving the annuitant are, if it's a single individual or it's a married couple, typically there's no issues. If the donor is different than the annuitant or a married spouse, there can be some different tax dynamics that come into play than the normal scenarios. But those are less common and would warrant some conversation, prior to making the gift.
Great. Okay. So jumping into, I think, what people are anticipating, can we talk a little bit about what's coming in 2026? So obviously the big beautiful bill was passed. How is that going to impact philanthropy? Can you describe some of those impacts?
Yeah. There's a couple primary things, maybe a third one for our highest earners. Um, None of this applies in 2025. All kicks in 2026. So that's why we really kind of emphasize today what you can do this year. Um, but starting in 2026, there's a new component for people who are claiming the standard deduction. So we talked about bunching, we talked about, the standard deduction being one level and itemizing, and you figure out which is going to give you the most benefit. And if you don't itemize, you don't get any of that charitable benefit. It's kind of already built into the standard deduction level. A presumed amount of philanthropy, I guess, is what's built in. Starting in 2026, there's going to be a brand new standard charitable deduction. So for people who claim that the standard deduction, there will be a new one on top of this one, and it will allow people who make tax deductible gifts and save their tax receipts, to write off a little bit. And for single individuals, it'll be $1,000. And for married filing jointly, it'll be $2,000. And so you'll get this incremental little benefit for your charitable giving that maybe didn't come through in 2025, precisely because you're claiming the standard deduction. So in 2026 there'll be this new layer that's available. So that's one thing. Of note with that, it's only available for cash gifts. It's not available for gifts of stock or any of those other types of assets that might be considered for donating. Switching to people who itemize, there's a mildly negative new addition that's going to impact charitable deductions, the itemized side of charitable deductions. And what's going to happen is whatever that number is, I make $2,500 of itemized charitable deductions. There's going to be a test applied to it, a calculation, and that calculation is going to be a reduction in what you can deduct. So maybe best illustrated by an example. Let's say that the person has $100,000 round number of taxable income. Excuse me, of adjusted gross income. Sorry. The new factor that we use is 0.5%. So 0.5% applied to $100,000 is $500. So I've made, in the same fact pattern, I have made $2,500 of charitable donations that I'm itemizing. That $2,500 gets reduced by $500, that 0.5% of AGI. And then I'm only allowed to write off $2,000 in my itemized deductions. So it's not an encouragement for more philanthropy. It's actually kind of reducing the tax benefit that people enjoy from their philanthropy. but it does kick in 2026. So it's important for people who are maybe thinking about what they might want to do in 2025, complete some gifts for the next year. If you're using your DAF, you could maybe do, a little bit more and then spread it out, or you could work with Josh and say, hey, December 20th, here's my big gift, but it counts for 25 and 26. Just want you guys to know, that type of thing, so that you avoid the haircut that is coming in 2026. And especially if you're contemplating something significant, CNC hopefully, but maybe another organization you care about. Not waiting until 2026 to get the gift completed will help you avoid the haircut that would otherwise apply to this larger thing. The third impact really only applies to our highest tax bracket earners, federal tax bracket earners, people that are at the 37% federal income tax bracket. There's an additional reduction that occurs. So when I have an itemized deduction, at whatever my tax rate is, let's just say my tax rate is 37%. If I claimed a deduction, it's saving me 37% of what that would be. I'm reducing my income by that same amount. It's kind of like a wash at that level, not these other things, not these other dominoes I was talking about earlier, but when we get down to that level right there. Starting in 2026, and only for the people who are at the 37% bracket, there is going to be a 2% reduction yet again, meaning that only 35% gets written off, not the 37%. And so for our top earners, our biggest donors, there's another reduction in the benefit of itemizing deductions, starting in 2026 under the bill. So it's timely for people to consider what they might want to do before year end, given that if you're an itemizer, these impacts are coming to a tax return near you soon.
So with Giving Tuesday tomorrow and end of 2025 coming up, it doesn't sound like there's any better time to consider supporting Compassionate Choices than right now, is what I'm hearing.
Yeah. And let's also not lose sight. Like we've got these little tweaks to the deduction amount. But using a qualified charitable distribution is a massively tax efficient by comparison to these little dynamics. It is massively tax efficient in your giving. So if you're 70 and a half and above, you're not even worried about itemizing if you're using your IRA and doing QCDs. So you got the best of all possible worlds if you're there. But even if you're not 70 and a half and you're donating appreciated stock, you're donating from your investment portfolio, you get to not only give away the capital gains tax and allow CNC to sell the shares with no reduction in value whatsoever, and you still get the deduction even if it's clipped a bit. But you also get to reset within your portfolio whatever your holding might be. If you're repurchasing NVIDIA, if you've decided NVIDIA has peaked and I want out, you can take a look but you didn't want to sell because of all the capital gain. You could give it away, keep the cash, buy an entirely different stock at a brand new cost basis. So there's a ton of flexibility that still exists in our planning, kind of independent of these changes that we're talking about with the one big bill.
Gotcha. Got a question, actually a couple questions. So this one's specific. Does the QCD in 2026 avoid the 0.5% haircut plus the 2% top earner haircut?
It definitely avoids yes. Well, let me explain how.
Okay.
It definitely avoids the 0.5% of AGI because you're not claiming a deduction. A QCD is a direct transfer. There's no itemized deduction whatsoever. To the 37% piece, it can. And the question is, if taking that money out, especially via a required minimum distribution, were to push you up into that 37% bracket, where in turn you're going to get that 2% reduction. If instead what you did is did the direct transfer via the QCD to charity, it's never pushing you up to 37. And so in that incremental piece right there, it's just a question of looking at the numbers and figuring out where you might be. And then if you have flexibility within this range, absolutely locking in and making sure you do the QCDs to stay down in that 35% level or below.
Cool. Going back to DAFs real quick, we have a question here about how capital gains are treated when you fund a DAF with appreciated stock.
Exactly as we've been describing them today. I've got my DAF set up with my local community foundation, let's say. I can transfer shares of NVIDIA into my DAF. The local community foundation in turn receives those, then sells the shares. And there's no capital gains tax taken because, again, there's no the community foundation is a nonprofit organization. Fidelity Charitable is set up as a nonprofit organization. So whoever the DAF custodian is can receive the shares themselves, sell it, no capital gains. So it's exactly the same, giving it straight to Compassion Choices or funding the DAF.
All right. And then I've got one more in here that I'm going to read. So this is from Anthony. He says, I have 5 sources of RMD funds this year that I need to take. I'm planning on donating directly from them to charities to get the tax benefits of the donation. How come not all of them, allow and handle the sending of the donation directly to the charity for you to get the direct tax deduction? So I guess sometimes the check is being sent to him and sometimes being sent directly.
Maybe I'm interpreting the question a little bit differently. I'm interpreting it as why can I do a QCD for my IRA but not my 401k or my 403b? I'll answer that question if it's maybe the person can pose it if it's different. But if it is that question, why can't we do QCDs from our 401ks? The entire nonprofit community is wondering the same thing. But for whatever reason, when legislation was put together, it only spoke to the QCD being available from the IRA. Here, I'm going to say something, but this is to be confirmed with a tax advisor as well. But it's my understanding that the amount that you have to give, excuse me, an RMD amount, or if we're getting into the RMD threshold, is calculated on your entire holdings. And each custodian is going to tell you what's needed to be taken from that particular account. But if it's a mix of 401k and IRA and you've got sources, as far as the IRS is concerned, you can do all of your distribution from the IRA, which opens up the QCD window, and satisfy the minimum, even if the minimum is spread across 401k, 403b as well. Now, that is absolutely something I would want to confirm with your tax professional, but it's my understanding that that is the case. And so again, the big asterisk of talk to your professional and make sure that you're getting the guidance from your paid professional, not some guy on Zoom. So
Well, thank you, Bill. I think that's all the questions that we have. So gonna wrap up. Bill, do you have any final thoughts you'd like to leave everyone with today?
yeah, maybe briefly. We're talking about tax characteristics and tax dynamics and philanthropy and all of it. And they're important, right? They're important. But we arrive at philanthropy really because we care about the organizations that we love, the work that they're doing, and we want to support this. We want to give back. We want to participate. We've had, some success in life, and we want to give back in ways that are meaningful to us. And when I think about Compassion and Choices and the work of this organization to establish the right to medical aid in dying and to defend that right in places where it's already been created and expand that right to more and more people so that this just basic human dignity, component is available to more and more people. That's the reason, for giving. And yeah, we want to, do it efficiently from a tax standpoint and all of that. But that primary urge, that primary source for it is just the importance of this work. And, the accidents of a person's geography should not determine whether they have, this option available to them or not. And so um, I appreciate everybody being on this call. Obviously, you're on the call because you already care, but it's incredibly important work. I happen to live in a state that has this available. I happened to be doing some work with Compassion and Choices at the time that it was established in this state, Colorado. And so I've seen this maybe a little bit more closely and kind of feel it maybe in some of the same ways you guys do too. Um, so just thank you for being part of this work.
Thank you, Bill. That means a lot. Happy to have you in it with us. Um, all right. Well, everyone, we are going to be wrapping up. I want to thank you all for attending today. If you have any questions at all about the presentation today or any additional questions, also if you want to talk with me about a charitable gift annuity or what the process of giving stock is like, feel free to send me an email. My email is jroth, first initial of my first name, and then my last name at compassionandchoices.org. Happy to get back to you. And don't forget, tomorrow is Giving Tuesday. All gifts match 100%. So thank you so, so much. I think that's all we got. Have a wonderful Monday and a great holiday season.